All right. Hey, everybody. Welcome to the Lifetime Value Playbook here. This is Jared with Flippa. We have Charlie here with us as well, who is with Azoic. Excited to be getting started here.
Hello, everyone.
We got a few people still trickling in, so we're going to get started here officially in a minute or two. But while we wait for some people to trickle in, feel free to throw a welcome in the chat. Let us know where you're from. And what you're excited about in the chat. I am based out of Ludington, Michigan. So if there's anybody else from Michigan, that'd be cool to hear. If anybody's heard of Ludington, that would be surprising as well. It's a very small town, shores of Lake Michigan, beach community, vacation community. If you think of a small Hallmark town that you see like in a Hallmark movie, it's what we are. So if anybody's heard of it, that'd be great. Tom, yeah, they've seen the ferry in Ludington. That's what we're known for. We got a car ferry that goes from Ludington on our side of Lake Michigan over to Wisconsin. It goes every day, drives cars and people over. So that's cool. Hey, Tom, thanks for joining.
And I'm joining over from San Diego area. Zoic's main headquarters is here in Carlsbad, so North County, San Diego. And I'm lucky to be here over here. We also have Alyssa from Zoic. She's in the chat, going to help out with some questions, collect notes, help write things out for me. She's also in the Carlsbad area. Oh, Hawaii. I'm jealous.
Hawaii's on the bucket list. Never been. It's top of the list for me and the family. It's a far trip from Michigan to Hawaii.
Yeah,
it's an easy day.
It's incredibly beautiful.
Yeah, I imagine. I've never heard too many people say bad things about Hawaii, Lauren. So very jealous. That's cool.
It would take a special kind of person to say that.
Yeah. Cool. And then we got someone
from Pakistan. Cool.
Awesome. And then on Flippa side too, you'll see in the chat earlier, Mike's here from Flippa as well. Again, happy to have Mike with us. He's going to be answering questions in the chat, things like that as we go.
Tom says his son's in Solana Beach. Probably saw him surfing. I am a surfing fiend, and I actually live in Del Mar, so Solana Beach is about 300, 400 yards away. So there's a very high chance that we surf together all the time without knowing. That's very funny.
Yeah, we got Montana, Latvia, cool. Chris and Tom, great to have you guys. Barcelona, Spain, cool. I had an exchange student who lived with me last year from Spain, so he was from Madrid. But awesome. All right, well, let's go ahead and get started. We may have some people trickle in, which is fine as we get going. But again, excited to have everybody with us. We are here today to talk about lifetime value, and from a Flippa perspective, it's really how can you maximize lifetime value, and why is it important to buyers, and why buyers are willing to pay more for a business that really has optimized the lifetime value of their customer compared to another. And Zoic's the perfect partner to have with this, because they're going to talk to you about what you can be doing today to actually put an action plan and a game plan together to optimize the lifetime value of your customers, do the thing that's actually going to lead to a more successful exit at the end of the day, the implementation of it. So yeah, great to have them with us. Again, I'm Jared. I've been a business broker for 6 years now. One of our senior M&A advisors here at Flippa. All of my time in the brokering world has been in the digital space. So working with sellers across, e-commerce businesses, software companies, content businesses, anything in the digital realm. That's where my specialties, really lies. And today I'm going to be bringing you what I really consider real advice from buyers. Part of my job is talking to buyers on a daily basis and understanding, what are they looking for in a business, what's important to them, and what concerns them moving forward. So we're going to discuss a lot of that when it comes to a buyer perspective of lifetime value, and as a seller, how you can optimize your business to meet buyer expectations. And then we have Charlie here with us, who I'll let him introduce himself.
Yep, my name is Charlie. Again, if you joined just recently, I've been with Zoic just over 5 years now. I've worked in two basically major teams. Originally, the first year and a half, 2 years was a lot of onboarding. So I got to kind of learn every advantage, every edge you could create while onboarding a site to kind of put yourself in the best position, which was super beneficial. And the last 2.5, 3 years, I've been in a yield strategist position, which is essentially, I kind of sit as a liaison between our sales team and our revenue operations team, which is great because I can look at all the back end with all the engineers figure out what's working, what's not, where the market's going, what we're changing, what we're A/B testing, and kind of apply those things to both our sales team, our PSM teams, like account managers, and kind of apply that to our entire network. So it's a constant learning curve, which is extremely exciting. So I'm happy to share some of the things we've been seeing today, and probably sound like a broken record on the important things, but that's all right.
Cool. Great. Well, thanks, Charlie. All right, let's go ahead and dive into our agenda. We're going to discuss 5 key areas today, and we have about an hour carved out. If you have to leave at any point during the hour, no worries. You will get a recording of this full webinar sent to you right after the call. So, but we're going to start talking about a buyer's lens. From a buyer perspective, what is driving higher valuations, and what are they really concerned about in today's market? From there, Charlie and the team are going to talk through growth strategies, how you can actually increase your lifetime value, things that are applicable to you today that are going to be also applicable to a sale later in the future. Then we're going to talk through strategy. When it comes to your exit, how can we meet buyer psychology and really build a business that is going to be easier to sell and sell at a higher valuation. And then we're going to go through just some quick exit readiness, things you could be doing over the next 6 to 12 months as you prepare to exit. And then we'll leave time for a live Q&A at the end as well. If questions do come up during the webinar here, feel free to throw them in the chat now. We have teams monitoring the chat, so they'll either answer it directly in the chat for you, or if it's something that we want to cover at the end of the call, we'll be able to reference back to that. So definitely use the chat throughout the call as well. All right, let's go ahead and dive right in. So let's start and talk through lifetime value versus traffic. And from a buyer perspective, what that really looks like and how buyers are evaluating quality versus quantity of users. Now, a long time ago, 5 or 6 years ago, buyers really were concerned with one number, and it was your overall traffic. What was the traffic doing? What was that number? Was it growing? Was it shrinking? And that's kind of where the diving into traffic ended. A lot of buyers just stopped there and said, okay, I like the traffic number. Let's look at other aspects of the business. Today, it's changed a bit. That traffic number, that overall number is important. It still gets buyers interested, but really, that's the starting point. From there, they're going to be diving much deeper into the actual metrics of your traffic and who the users and the customers of your business are. Predictability is going to get them comfortable. And so the predictability of that traffic and how it ties to your revenue is going to significantly reduce the perceived risk that a buyer uses and looks at when valuing your business. And when it comes to paying a premium for your business, it really comes down to lifetime value of that customer. It's going to help justify that premium. I'm talking to buyers every day, and they really want to understand who the users are of the businesses that they're out buying and how they can optimize the revenue of each user moving forward. And what's being done today, what's not being done, and what could be done into the future. And so, do users have a reason to come back to your website or to your business? That's what buyers are going to be analyzing and looking at. What is the value proposition that you're giving a user? And do they have a reason to come back for that value proposition? When it comes to growth, are we just dependent on one channel? Call it SEO, paid ads, whatever it may be. Is it consistent or is it dependent on that one channel? Because if you put yourself in the shoes of a buyer, a business that has a ton of dependence on paid ads is going to be seen as considerably more risky than a business that has some organic traffic, has a newsletter, has an SMS funnel, a content business that has lots of different traffic sources, compared to one that's completely dependent on Google for traffic is going to be seen as much less risky. And so, is there growth dependent on one traffic source or not? And then how can I improve monetization without rebuilding the whole business, right? As a buyer is looking at different acquisitions and opportunities in the space, they don't want to have to rebuild the business from start. And that's the way that they view a lot of businesses where their traffic and user is coming from one source. And there's not a lot of data, information, and understanding of who those users are. And so is the audience real, or is it just temporary traffic? That's what a buyer is ultimately viewing. When they look at businesses, it's a brand, and I'm buying a brand, and do people come back to that brand consistently, or is it just one user comes, they leave, and they never come back? And am I always dependent on finding that new user? That's going to be seen as considerably more risky for a buyer, and ultimately buyer's valuation comes down to their perception of the risk of the business moving forward. So when it comes to lifetime value, it's all about optimizing that lifetime value of that customer today, understanding those customers so that we can reduce a buyer's perceived risk of the revenue of your business continuing post-sale. And so Charlie is going to talk to us a bit about that value beyond that click and the lifetime value of the traffic.
Yeah, so to first start off by repeating a little bit of what Jared said, page views don't exactly tell you a whole lot about a business. I think for a long, long time in the programmatic world, it was how many visits, how many page views, and then there's kind of an assumption from there, but like, okay, you must make X amount of dollars per month. I mean, the equation that goes into how much you're making a month is 15 to 30 to 40 different variables. You have ad density, where's the traffic coming from, what's the engagement signals. So I think the initial idea I wanted to really repeat here is the fact that page views are a number, revenue per month is something else. And while there is correlation, some causation there, it's very important to kind of establish those as two different things and then understand the variance there and then how you can actually grow it. Page view growth can be pretty expensive and isn't always super fast, but revenue per user growth can compound on the same traffic that you've already paid for or you've already kind of established. So that's something that I want to refer back to Jared when he was talking about kind of like an owned audience. Is this traffic coming out of thin air from maybe a viral hit, or is this an owned audience that you can kind of control and stay away from algorithms? Another thing I want to touch up on now, but I'll repeat a little bit later, is basically the shift in the market that's kind of happened. It's been very interesting. I think AI has come into the world and has kind of shifted many, many markets, regardless of kind of where you exist, whether it's economics, media, or anything of that sort. And kind of what we've seen, as you guys already know, is that SEO traffic and referral traffic from there has kind of been cut unless you're one of the top dogs, I'll say. But that's not, that's actually not a bad thing. And I want to actually talk about that a bit because we're seeing higher value audience from other places that are kind of what I'll refer to again as algorithm independent. You're not relying on someone else's audience that you're licensing, you're kind of renting from. I'll use those terminology. But these are real owned audiences that can kind of turn into repeated users. So I will talk about that again in a bit. And then a huge one is basically this media quality. And this kind of refers back to the post-AI change in the world we've seen. I think before, a lot of the times the publishers kind of had the power in the relationship with the buyer. I think they were in kind of control of it a lot. But as that market kind of shrunk, from an SEO standpoint, you have this power shift go to the advertiser. So advertisers are now saying, I can be a little bit more picky on where I want to buy. If our budgets are going to continue to grow for the programmatic world and serving ads, we need to make sure our ROI is super calculated. Not only is it calculated, but is it growing? So there are a couple ways when I refer back to media quality, that's essentially what we're doing. Is X premium advertiser willing to buy on my inventory? And I think the real answer is the quality there, and is the ROI also there? I'll go into this a bit more, but the underlying idea that is really kind of ensuring is that the higher the ROI for a premium advertiser is going to also mean a higher ROI for you as a publisher. So it's not one of those scenarios where you have an advertiser winning and then the publisher has to maybe like take some of that premium and maybe not earn as much. We now have this like really nice calculation where a premium advertiser sees a site that they really, really like. They're going to be willing to spend a lot. And through some of the systems that we've set up at Azoic and through the market, publishers will also be earning more. So that's really the beautiful thing that I want to drill down here. This isn't a negative thing at all. I think this is some of the practices that have happened post AI in the last 2-3 years are things that the market could have really benefited from 5 to 10 to 15 years ago, because I think advertisers will be really happy to jump on some of these sites based on the media quality and some of the other things that I'll talk about again. But another idea is that a user who reads like 3 articles, scrolls all the way to the bottom, and returns the next week is worth 10x to maybe 15x more than someone who comes to the page and bounce. So something I'll refer to a lot throughout this presentation is like your engagement signals. And those engagement signals of your users actually feed directly into ad auctions directly. Like session depth, time on the page, return visitors, return visitor frequency and percentage. Those aren't just analytics metrics. Those are actual revenue inputs that will feed and kind of help you understand your business. So when we think about all these things, we want to think about that both as growth and stability. So, a high LTV means you can reinvest more per visitor that you've already acquired. And from a stability standpoint, LTV smooths out traffic volatility. So while volatility can be great on the up end, maybe you have a viral hit, maybe you have this or that kind of refers back to Jared's point of, is this a confidence buy, or is this just random volatility that we see throughout the years? Because, 1 year, if you see $200,000 in revenue, and the next 250, you might say, great, this is compound growth. Well, revenue per month might be down, and you have a couple of really high viral spikes. Are those viral spikes repeatable? Sure, yes, maybe, but not with high confidence, which, we'll talk about more, but that goes into the confidence of it all. And then something I'm really excited to share about is kind of the new revenue paths and the formats. So a lot of times we'll work with clients where we have the same flows, we have the same traffic, whether it's direct or from a newsletter or from maybe like a Pinterest page, but we can kind of alternate the paths that these users go through and the different formats they see. And oftentimes we can kind of segment users into different buckets and say, look, super high intent users can make sometimes 80 to 90% of the revenue. That is very subjective based on the domain. But the idea here is that you can understand the intent of a user and then basically capitalize on that based on like a value of exchange, which I will go to in a bit more, but I want to kind of plant that seed. And then to the point on the right from an asset type, I think the thing that I really want to just drill down here is that it's the same equation for different domains and different type of domains. It's basically your value and your frequency times time. These are just different inputs, but knowing which one you're optimizing for really tells you where to spend your effort and which levers to kind of pull. So that's kind of the main points I want to drive home, but I'm going to go into this a bit more, but I wanted to kind of plant those seeds for you guys so you can kind of get an initial understanding of what I'm going to get into.
Yeah, cool. Awesome. Well, thanks, Charlie. And it's interesting to hear like advertisers' perspective on, what they're willing to pay more for and less for. It's very similar to a buyer perspective when they're analyzing your business. It's interesting how many times buyers or sellers will come to me and will compare 2 different businesses, and that one will have, significantly more traffic, but it will be optimizing that traffic way less. It'll be the revenue of that business will actually be less than somebody who has 25, 30% less traffic, but they're really optimizing, revenue per user and visitor to the page. Yeah, super interesting. Let's talk a little bit about, from a buyer perspective, how lifetime value is going to impact valuation. So when a buyer is evaluating a business, they're not just looking at profit in isolation. They are trying to understand the quality of that profit today. And really, what are the probabilities of that profit continuing into the future at a similar or a growth level? Buyers tend to pay more for businesses where revenue is going to feel repeatable, because that repeatability is less risk for them. And buyers factor in risk into valuation. So if a business has repeat usage, returning visitors, reoccurring revenue, a strong audience relationship, all this is going to lower perceived risk of a buyer, especially when they're comparing multiple assets. That's the thing that sellers need to keep in mind is when you go to sell your business, you're not the only bell at the ball. There are dozens of other sellers with similar business as yours who are trying to capture buyer interest. And so as you're building your business today, you need to build it in a way that is going to optimize for capturing buyer interest at the time of sale. And you can do that by fully understanding your customers and optimizing for lifetime value of your customer and repeatability of that revenue. It's really the bridge between a business being a traffic play and having a premium asset that we can go to market with at a premium valuation. And there's two areas of this that I would say are core focuses for sellers, and that buyers are going to analyze during a due diligence. And the first is predictability versus volatility. They're going to want to know, hey, is this a business that, it has a stable trend or it's upward? I can have confidence in the revenue continuing. That's going to be easier to underwrite moving forward than something that has, spikes of revenue, something that, one article went viral or ranked really high for a search term, but no longer ranks that high, or maybe you had a paid ad that, did really well, performed above average and spiked revenue for a few months. That type of situation is much harder to underwrite future cash flow moving forward. Now, buyers are analyzing and valuing your business off of previous cash flow, most often the previous 12 months of profit. But in terms of the confidence multiple that they're willing to pay for that profit, it comes down to how confident they are that that's going to reoccur. Then they're also going to look at retention and acquisition dependency. So, a strong returning user base, that the seller understands, they know who they are, they know how to target them in different ways. That is going to be a business that a buyer is going to be willing to pay significantly more for from a valuation standpoint. And so those are two areas where, if I'm building my business and I'm looking to sell in the next 6, 12, 18 months, 24 months, the first thing I tell a seller is put yourself in the shoes of a buyer. Like if you were a buyer today, would you be confident that your traffic, that your revenue is going to continue at the level it is, or with some growth? Or are there areas where you could poke holes in it? Because as a buyer, they're going to come in and, any area that they can poke a hole in, they're going to, and they're going to use that as their advantage to negotiate the deal. So those are things I would focus as a seller. And this really applies to all asset types. Lifetime value, oftentimes, from a high level is often thought as like, yeah, this is kind of a software metric. Maybe there's some, metric I could apply to my content business, but really across all asset types, this is something that business owners and operators should be focused on. From a content perspective, buyers are going to be looking at LTV in the lens of, hey, is this a loyal audience or is this SEO only traffic? Are these users who there's multiple funnels bringing people to the website, or is it just, they rank good for some search terms and, that is a place where buyers are very concerned right now, with the way that Google is handling search and incorporating AI into search. There's a lot of uncertainty around that in the future, and uncertainty leads to perceived higher risk. Perceived higher risk leads to lower valuation. So anything you can do to have more understanding of your audience and control of where your audience is coming from and ownership of the audience and a content perspective is going to increase your valuation. From a SaaS, LTV has always been important when we're analyzing software companies for buyers. They're going to look at, retention, churn stability, the expansion of revenue, the quality of that reoccurring revenue. A SaaS business with low churn, a buyer perceives as, much less risky than something with high churn. You continue to have to, refill the funnel and in the bucket. And so it's always been a metric that's important for buyers. It's becoming more and more important with, we don't want to beat on a drum here, but with AI, disrupting the software industry a bit, that's a huge metric for buyers nowadays. The one area that has become really interesting and is completely different than what it was, 5-6 years ago is in the e-commerce space. LTV was not a metric that a lot of buyers of e-commerce business worried about 5-6 years ago. In the day of Amazon aggregators and, funds raising a bunch of money to buy e-commerce businesses. At that time, they were just, buying Amazon FBA listings that were 100% dependent on Amazon search engines, Amazon PPC. It was, one listing. They didn't own the customer whatsoever, and this was not a concern. Lifetime value was not talked about between buyer and seller at all. A lot of those businesses struggled post-acquisition, and a lot of it was because of, change in Amazon search engine. The way that Amazon did their PPC changed over time, and rankings declined for a lot of these listings. And buyers started to understand, okay, I don't have any control over my customer here. My lifetime value of my customer is, one purchase, and then I need to go find them again. They're not coming back to my listing. They're going to Amazon, searching the same term, and now a new listing is there. And my brand is not important to them. That's completely changed now, where buyers are looking for a brand, and that's when you hear this term brand thrown around a lot. But what buyers are really saying when they say I want a brand is they're saying I want something with a high lifetime value, where customers are coming back, they're repeatable, and that's really important. Is there subscriptions in the business? Are customers coming back? Is there email or SMS revenue? Consumable products, reorder behavior. All these are metrics that buyers now want to see that they really didn't look for 5 or 6 years ago. So a big change in the way lifetime value is used to value an e-commerce business, and that impacts valuation significantly. One of the biggest things outside of a business being healthy from a revenue perspective, a profit perspective, it growing, one of the biggest things that impacts valuation is lifetime value of customers. And it not only impacts the valuation, but it's going to impact the structure of an offer as well. Is this a cash deal? Is it less cash today, but more based on future performance? Is there a seller note? All of these things, businesses that have a good understanding of their customer and have a high lifetime value and can prove that they do, tend to get a much higher valuation. And we see this in the real world. So I'm going to go through two deals here. These are real deals that happened on Flippa over the past 12 months. I think one of them was about 3 months ago, the other 8 or 9 months ago. So a little bit of time difference between the two, but not substantial. And they're very similar assets. They're both food blogs, a little bit different overall niches, but basically recipe blogs, nutrition blogs, things like that. Deal one, it did $225,000 of revenue. Of that, $165,000 was profit. Deal two, slightly larger, but similar, $300,000 revenue, $215,000 profit. So I'm going to dive into the metrics of these businesses, and you'll see how lifetime value can really change the way that a deal looks at the end of the day for you as a seller and as a business owner. So deal one had pretty diverse traffic. And when we look at the breakdown of the traffic, 40% of it was organic. Not concern, not surprising. A lot of food blogs do depend on a lot of organic traffic coming to them. But the seller did a great job of diversifying over the last 3 to 4 years their traffic. And so they had a lot of traffic coming from Pinterest. 25% of their overall traffic was Pinterest. They posted daily. They're very active on Pinterest. 12% of their traffic was direct. So they had some type of, customers clearly liked their content and they were coming back just direct to the URL. Email list. So they did a great job. They had a funnel set up, a free PDF that users could get. If they gave them their email, they get in their newsletter, and then they could target them via the newsletter. They had some sponsorships in the newsletter as well. So they get other revenue coming through the newsletter, which buyers really liked. 7% of the traffic was social, think Instagram, Facebook, TikTok, things like that. 5% referral and 3% other. So this was a very diverse traffic breakdown. And more importantly, this was a traffic breakdown that allowed the business owner to capture a lot of data and information about their users. They knew who their users were, and the users were not dependent on one source of traffic to land on their website. This led to a lot of buyer interest. We had 7 total offers. The seller ended up accepting an offer that was 2x upfront. 2x, when I say that, I mean 2x on the profit or the EBITDA figure, which was the $165,000, and a 0.75x seller note that was paid out over 12 months in equal payments. Total valuation was 2.75x or $453,000 was what they walked away with at the end of the day. On the other deal, again, a very similar asset. Same business model and ultimate goal, which was to get people to view their blog pages. Traffic breakdown was much different though. 82% of it was organic, meaning it came right from Google, right from search engines. Google, Bing, Yahoo. Majority of it being obviously Google. 8% of the traffic was Google Discover, 4% direct, 3% social, 2% referral. So this seller, all they did was focus on SEO. They didn't capture any emails. They didn't run a newsletter. They didn't focus on, Pinterest traffic or other social traffics. It was just organic SEO was their bread and butter. Now, this site was much older. It was almost 20 years old. It had a lot of history behind it. The URL was strong. The domain was strong. So that it had that going for it. But in today's age, buyers were very concerned with the organic search traffic, and rightfully so. Whether that concern is justified or not, it's the buyer's perception of that concern that is the reality. A buyer's perception is their reality, and ultimately that's your reality when you sell. And so buyers factored this in, and it was factored in by just less overall interest in offers. We had the same number of NDAs signed roughly, so the same number of buyers that looked at the deal, but ultimately we only got 2 offers. One of the offers was, a really low ball offer that I would almost consider not an offer at all. The second offer was still a lower offer, but it was the one that the seller accepted. They accepted 1.2x on their profit up front and a 0.5x seller note. Their seller note was actually 2 years. And the total valuation was 1.7x or $365,000. And so you can see how the repeatability of the traffic, the confidence in the traffic, and really the understanding of who their customer was really factored into the way buyers value this business or a business. Because deal 2 ultimately did more profit, right? It had just as good of margins. It was just as healthy as a business. It wasn't declining month over month. Revenue was relatively stable. Traffic was relatively stable. But at the end of the day, they were doing $50,000 more profit than deal 1, but they walked away with almost $100,000 less at the end of the day. So very real world, interesting example of how lifetime value is perceived by a buyer. They valued the lifetime value of these customers of deal 1 significantly more than deal 2, because deal 2, they didn't know who the customer was. They were dependent on Google. One thing changes in Google, a couple articles start dropping in ranking, and the business looks substantially different compared to deal 1, where they're sure, there could be a traffic hit, but they ultimately have other avenues to acquire customers, reach customers, and the newsletter and the ownership of that customer in the newsletter was seen as a big value add for a buyer. So that's a great example of real world lifetime value, how buyers are going to view it. And as your job as a seller is to start building an asset that buyers are going to perceive as less risky in the future. And the best way you can do that is by maximizing lifetime value today and truly understanding your customer. And Charlie's going to go into how Zoic helps their customers do that every day.
Sweet. So yeah, this is going to be the exciting portion for me of what I want to share, because this is kind of what I do on a day-to-day basis. But essentially, what we always want to look at to start is kind of your engagement metrics and your audience itself. The reason we look at this is because if we have a certain customer, publisher within our network or out, let's say they're seeing CPM suppression over time, the first thing we'll always do is basically look at the engagement. Every single advertiser will basically get kind of post-auction metrics. So they're going to know historically of what that data was and what that data is now currently. So they can always look back and say, hey, where is this site going? Where are the users going on this site? AKA, are they bouncing earlier? Are they going to as many page views? Are they getting as low on the page? And then they can make basically a calculated decision on A, if they want to buy, and B, how much they want to spend. So again, session depth, page views per visit, and return frequency are like the 2 metrics that can move your LTV the fastest. If you get a user on some really good content, get them to engage through the page, so then they can be like, oh, here's a second article, I would love to read that. You've just doubled that single user's value. And doing that incrementally over time is extremely valuable for obvious reasons. There's a lot more I can go into that, but at the end of the day, the data is going to tell you which users are high value. So you can kind of stop treating all segments of traffic the same. Again, like I said earlier, you have different formats and funnels of users. So kind of understanding the intent of that user is going to help you establish which levers you can pull in terms of ad formats, ad density, and things like that. But I think the thing at the end of the day in this first section I want you to understand is that advertisers do get a lot of post-auction metrics. So they're going to know kind of what you're doing and what your users are doing, both historically and currently. So for example, sometimes we'll have someone come to us and say, I have very similar traffic source is the same, but I'm kind of seeing CPM compression. I don't understand why. And a lot of the times they'll say, I want to come to you guys and I want to test maybe an additional unit in the sidebar, maybe another additional unit on the top of the page, because they might think, well, more ads, more revenue. And if that's true, that's going to be true tomorrow, but that's not going to be true next week, because advertisers will now say, we now have a more dense setup. My impression that I'm serving within any viewport is now kind of less valuable. So that's kind of the balance we try to find. We say, hey, we can make you more money, but sometimes the best thing to do is to take a step back. And you might say, okay, well, that's not reassuring. But the whole point is you want to build up that credibility and the trust with these advertisers and say, hey, let's build up these post-auction metrics. Let's get session depth down longer. Viewability of that impression can be higher. It's more guaranteed to that advertiser. So similar to what Jared said earlier, if you kind of align the perspective of a premium advertiser buying an impression slot to also a buyer looking to buy your site, it's a very similar perspective. These are metrics that we want to build over time that can point to very high lifetime value and then kind of point to a very high value of exchange for a user. And I'm going to go back to this media quality that I was speaking about earlier. This has become super forefront. So this is extremely important to consider when you are considering growing your site, changing your site. Advertisers are using a lot more third-party tools nowadays than they were back in the day. And they're basically saying, is this cheap reach? AKA, is my impression worth it? Is it worth buying? What's my return on my investment? And they're investing in a lot of third-party tools that will basically establish some type of grounds on, is this site high quality or not? So a lot of the times they'll say, like, a super simple question I like to tell people is like, is this safe for my grandma to read? Is that a positive sentiment or is that a negative sentiment? Is the connotation of this brand positive or negative? And that's actually a huge indication on whether an advertiser is going to be willing to buy. And when you do that in mass, you basically build a premium bucket of high competition. So taking a step back early to increase those engagement metrics and increasing your media quality might bring in more advertisers around the clock. CPMs might slowly climb, but then you might start to realize, well, you now have high paying brands like Honda, Toyota, Nike, Adidas. This high premium competition is now tenfold. So you'll see your CPM start to slowly climb because advertisers are saying, well, this is worth it. We're getting a return on our investment. These users are really highly engaged. Let's spend more incrementally. And that's where you see that real long-term growth. So a lot of the times people might think, yep, more impressions, more revenue. That's true. But if that viewability and kind of the perspective of the advertiser is declining, then so will the CPMs over time. So that's something I really wanted to drill home. And then that second point there is called SPO. This is called supply path optimization. So this has been another huge shift in the market around, the last 2-3 years, maybe even less than. And it's basically the avenues and the channels that advertisers are buying through. So historically, we might work with 20 to 30 plus demand partners. And within that, we can basically have an ads.txt file. I'm sure some of you guys are aware. And if you're not, it is essentially a file that will authenticate certain people to buy on your site. So like if we work with the trade desk, we'll have an ads.txt file on the site that will give the trade desk basically the authority and the verification to buy on the site. And within that ads.txt file, each partner is listed as either direct or a reseller. A reseller is just a partner that can say, hey, we'll take that auction, we'll bring it to more demand, we can pull a higher CPM. But what happens at the end of the day is even if they bring in a very small, incrementally higher CPM, what happens is the path for an advertiser to buy grows so much that you have 4 to 5 people in the middle grabbing small pieces of that pie of the revenue stream, which then end up diluting your CPMs more than if you were to have a direct buy path. So supply path optimization is simply about getting more optimized revenue streams from auction to bid. So what that looks like is smaller ads.txt files. We continuously test our ads.txt files with all of our different partners and say, hey, is this partner buying direct? Are CPMs up or down? Hey, this reseller brings in a lot of really high value buyers. Let's test whether that path, direct or reseller, is incrementally growing CPMs or deteriorating them. So media quality and SPO, I put them together because they're both about, they're kind of like a quality metric from a bidding standpoint. Is the media high quality, and is the path at which we buy high quality? So when you work with someone like a Zoic, we will basically label the top of our ads.txt files and say, we are kind of like a manager of the auctions. We are a manager of these domains. And all the third parties and the big buyers know in the space that this is a green light of trust. I know that working with a Zoic, their supply paths are optimized. So whether you're working with a Zoic or not, the media quality and the supply path optimization is something I would absolutely look into with your current partner and say, are these things optimized? And if they maybe don't know, then that's a great avenue for you to look and say, how can I improve this? You can reach out to one of us. I'm sure you'll get my email after this, and I can, I'll happily look into this for you and say, this is what's going well. This is what's not. I'm happy to share that information with you guys for free, of course. And then the last one from the audience standpoint is the newsletters. This has been the biggest golden goose egg ever in the space. I have a pie chart after this that you guys will kind of see. It kind of explains this better. But essentially, newsletters are offering the most valuable information to buyers possible. Newsletters are now allowing us, as Zoic, to pass like encrypted hashed information on the user to the advertiser, so they can know exactly who they're buying for. Historically, and the overlying idea is that if I am Nike and I'm trying to buy on a specific audience, the more information I can know on that audience, the more I'm willing to pay. So the example I like to draw is, let's say Jared has a website. I sign up for Jared's newsletter that goes to his website. Jared works with the Zoic. He can basically pass an encrypted information. When I click on the newsletter link to go to his website, that will say, hey Nike, I have this encrypted user. And if I already have shopped with Nike and Nike already has my email, they'll say, oh, I also have this encrypted user. Based on the data that we already have from this user that we've stored, we know that's Charlie. We know Charlie loves the new Air Forces, or he loves these new basketball shoes. Since we know that, we're going to 5x our CPM because we know exactly what we're doing. So at the end of the day, the higher the targeting for the advertiser, the more they're willing to pay. And there's quite literally no better way to do that than what we call a deterministic ID, which I'm going to go to a bit more in the next section. But it is basically, you can use the definition and say, we've determined who this user is. We're going to pay a lot of money because they're also in our database and we know what they like. So when we go into revenue and UX optimization, the myth is that more revenue is worse UX, but that's not true, because with all the data that we've kind of talked about historically, engagement, session depth, return frequency, we can say that when this is done right, they actually move together. So more revenue equals better UX because we're understanding the intent of the user better, and we're able to offer them that value of exchange at a better rate. So another way people do this, is through different formats. So a lot of the times we have customers come to us with simply just display units across the page. They say, this looks nice, we like the layout. But in reality, we can implement a video unit. And we know that historically in different sites and different segments, video units don't hurt UX at all. Of course, that's subjective depending on the actual scenario laid out, but we'll have the data to back it up. And you can actually leverage video units, display units, and other things like a rewarded ad unit. And so that every format you layer on top is basically incremental revenue from the same audience. So that's a very easy way we can go to a publisher that's historically run the same setup for 10 years and say, look, we can run a sample, we can run a test, an A/B test on 5%, 2%, 10%, whatever they're comfortable with of traffic, and then look at the engagement of those users and make an informed decision for the entire business. And what ends up happening is we have old business models that kind of take on that understanding of a simple A/B test. And then we can expand those A/B tests with positive results to the entire website, to the entire network, 100% traffic. And we can see like 60% returns. So, anyone earning $100,000, they can easily go to 125, 145, 150, depending on the understanding of the engagement and that value of exchange. So the third point in this revenue and UX optimization is the most important one I'm going to refer back to. This is that idea of the deterministic ID. Historically, it's always been third-party data. So, hey, I know where this user is located. I think I know what device he's on. I kind of understood where he's from. And I can make an assumption on who this user is and say, this is probably Charlie based off this information. But again, if I'm coming from a newsletter and that's first-party data, encrypted information, premium advertisers are going to know exactly who that user is. And again, the highly targeted information equals higher value for you as a publisher. So that's basically the entire investment of most businesses that we've been working with. If you don't have a newsletter, get working on one. And then we can go into the utility because I want to also talk about that from the first-party standpoint. So every return visit is basically compounding LTV at zero acquisition cost. And then you basically want to think about balancing the trust of your advertisements to the content itself. So it's simply a value of exchange. One very common scenario I like to think of when we think of value of exchange and what that might look like. If you've ever recently flown on any of the airlines, recently I was on Southwest. They used to make you pay for Wi-Fi. I know texting was always free, but now what they simply do is they say, hey, watch this rewarded ad for 10 to 15 to 30 seconds, and you can get free Wi-Fi or texting on the site. So that value of exchange for me is super easy. I'm happy to watch that 15 to 30 second ad if I get free texting for the entire flight. That's kind of the underlying idea you want to think about when you have this value of exchange I speak of. And then from the utility standpoint, back to the first party data, there's a lot of ways you can kind of capitalize on the existing audience. So when you have a very viral traffic spike, if you can capture some of that audience to make them come back over time, that's going to increase basically the security of your LTV. So one way we see a lot of publishers do that is do like a Google one-tap login. If you go to a website, you might see the little Google pop up in the top corner and say, log in as this user. You can basically set up a user, you can set up a listening event with certain permissions that you get granted from the user. And that way you can store that information and then retarget them through high value pages that you've already given out to users that have a very high RPM or EPMV, and then target those users again and again and again. So while viral traffic is great, you can actually capture that audience and then move forward and retarget them forever at no cost. You're algorithm free. This is algorithm independent. And again, it's zero cost. And then you can basically calculate your monthly reoccurring revenue and say, look, my average opening rate is X. I send this amount of emails out. That means I can estimate my reoccurring revenue as this. And that's going to build that buyer trust that Jared keeps referring back to. So the golden scenario is like if you have a newsletter and you have a really good value of exchange, user journey is very highly engaged, and you can 3 to 4x RPM very, very easily. The last point, subscriptions. We are in a subscription world. The whole point is that a lot of the times you see 95+% or more or around that not subscribe, but that 95% is actually a very monetizable traffic source. So we want to think about the non-converters as still a very high value of exchange in terms of revenue. So the best people in the space optimize both. Subscriptions, great. Non-subscribers, great. Let's capitalize on those through good formats. So the next pie chart is the really exciting opportunity. This is from last year's data, but the left pie chart basically says this is the percentage of users that want to buy on domains with that first-party encrypted information available. So whether that's a login, a forum login, a profile login, a newsletter, an SMS, aka any way you can encrypt a phone number or an email, 93% of advertisers and premium advertisers want to spend there. And this is last year's data, so it's probably higher now. And then that 24% is basically the percentage of open web users that are actually utilizing that information, whether they have it or not. It's probably higher now as this was last year, but it's far less than 50%. So if you are sitting here and saying, how can I grow my business, whether I have it or not, I'm looking to buy, invest in a newsletter, invest in capturing that first party data. And then you want to work with a partner that knows what to do with that first party information, because a lot of different premium advertisers use different signals, and utilizing every signal across every funnel and every format is going to grow your revenue an insane amount, not a little amount, an insane amount. So that's the underlying idea. You have a massive opportunity where people want to buy, but there's not enough real estate for them to buy on. So kind of thinking about this equation, how can I grow my first party segment? And then capitalizing on it with a partner that knows how to use which signals is going to put you in an insanely good position.
Yeah, absolutely. And the cool thing is, like, that's putting you in a great position today and to maximize revenue and profit today. But it is going to also significantly make the selling process easier on you, and make it easier at a higher valuation too, which almost seems counterintuitive. But before we wrap up here today, just want to talk through maximizing your exit value through lifetime value. So once you do all the stuff that Charlie mentioned, at that point, you're going to come to a place where it is time to think about the exit, and translating that lifetime value improvements into higher multiples is exactly what you're trying to do here. Buyers are going to come in, and they're not just going to take your word for, hey, I know who my customer is, I have all this data on them, etc. They're going to want to see that, and they're going to know that that's accurate and true. And so they want to see proof. They want to understand where the traffic comes from, how users behave, how revenue is generated, and whether there's concentration risk within those customers or not. Due diligence is really where the rubber meets a road for a seller, and part of due diligence is being very prepared as a seller in the process. So as sellers, when I read through listing pages and I'm looking through sims that sellers have put together, a lot of them lack the real data to back up what they're saying. They say, hey, we have a great audience. We have an awesome newsletter. We have, XYZ, fluffing up what they have, but there's nothing that backs it up. And so, sure, you have a great audience, but, let's show returning visitor trends. We have a great newsletter engagement or newsletter. Let's show all the engagement in the newsletter. We need to show repeat customer rates, direct traffic numbers, revenue per session, revenue per customer. How can we show, and what data do we have that's going to prove that that revenue is durable, so that everything we gave the buyer that they made offers on, during that due diligence period, we can justify and back up. The better you can prove that lifetime value story, the easier it's going to be for a buyer to believe that future cash flow. Because a buyer, again, ultimately they are valuing your business on the past 12 months EBITDA, but really what they're trying to determine is how repeatable is this profit figure that I'm purchasing, at a significant premium, at a multiple. And so when buyers believe in that future cash flow, when they're very confident in it, when their perceived risk of that cash flow drying up is very low, they're going to pay way more for that type of cash flow. Back to the previous example where one seller walked away with 1.7 compared to almost 3x for the other seller. On a buyer willing to pay almost double for that same relative cash flow. So yeah, understanding the buyer psychology there is incredibly important in terms of maximizing your exit value. So hand it over to Charlie here to go over some common mismatches here.
Yeah, I think one thing I want to quickly say when I am getting to this point, I've referred to viral traffic as, and I want to think that as like a negative connotation. It's just trying to build the trust for a future buyer. So one common thing we see people do is with like maybe an SEO update or a very, very viral spike is that they've kind of captured a moment, but not the actual audience. So doing something like having a newsletter sign up or a profile login or a one-tap login can kind of give you that reassurance for a reoccurring visit. So viral traffics are great. viral traffic spikes are great because it's great revenue for the day, but you want to basically capture that audience and not just that moment. So that's something I want you guys to think about. And I think I spoke about virality as a kind of a negative, but I really didn't mean that. It's more about capturing that audience and then using that again. And then the one thing I really want to say again is that recognize the value of your site. Every user is going to your site for that value of exchange of piece of information or content. Don't lose the sight of that vision and don't try to do too much there, because if you create too many obstacles and barriers for them to get that, that's when they might not come back. So always recognize the engagement metrics, always recognize the value of your site and go from there. Always refer back to data for verification. At Azoic, yes, we do ads, but I think at the core, we are a data nerd company. We geek out on data. We have more data than we typically know what to do with. Now that we have AI, we can get through all that and make, pretty smart decisions about it. But always refer back to the data when you're making these decisions, because it's going to be super, super valuable. We have very simple ways to do this. And then in our system, let's say you have a very typical funnel, but you want to test something. We have very easy ways that you can set up on your own end to A/B test things at 10, 15, whatever % of traffic you would like to do so. So having the availability to test and engage, to test and then also view that engagement and go from there, make those informed decisions on your business, and always, always, always refer back to the data. And then the last point is basically, I really just wanted to put out eCommerce as an example to basically challenge your existing judgment on ads in the ad space. We're actually seeing that e-commerce is one of the faster growing segments in the programmatic world. Historically, people would say, that's crazy. Why would you ever put ads on a site where I'm trying to convert users to buy? The reality is maybe 95%, maybe 90% on a very good day actually convert to buy. So you have 90% of your audience kind of going through the abyss and maybe not coming back or ever converting. And that 90% to 95% of non-converters is extremely, extremely valuable by having maybe a simple ad layout. And you can actually find that a lot of times it actually doesn't change conversions, because users go to the page knowing what their value of exchange is for. They're looking for something. Whether they convert it or not is not always solely independent on the actual ad setup or if there's ads there or not. So that's something I really just wanted to drill down there and kind of challenge your pre-existing ideas on that.
Cool. All right. So we're going to jump right into just key takeaways here, because we're coming up on the top of the hour. So, and then we want to leave a little bit of time for questions as well. As founders, I really have 5 takeaways I want you to leave here on the Flippa side of things. When it comes to your valuation, when it comes to a successful exit, understanding that buyers pay for predictability, not just performance. So as a buyer's analyzing your business, they are going to be looking at the predictability of that revenue, of that performance over the past 12 months, 24 months, and how predictable is that to move forward. The more you can justify that predictability, the higher a buyer is going to be willing to pay for that cash flow. The more they're going to be willing to pay for that cash flow. Buyers also really want to know the quality of an audience. The term brand is very important in today's market. Build up a brand. Make sure people want to come back to your brand, whether that's an e-commerce business, a content site, a SaaS company. Make sure that there's some loyalty to who you are, and that you're not, people showing up one time and they never visit you again. So that exchange of value that Charlie talked about, it's there, and it's enough to keep people coming back, to you as a brand. Reduce perceived buyer risk before going to market. This is huge. Again, sometimes it's, just got to play the game. The buyer risk, and the way that they view risk is their reality. Their perception is reality. And sometimes their perception is wrong. They may buy a business that they thought was less risky than another, and it turned out to not be the case. But we need to play into the things that buyers view as risk and perceive as risk. Do your best to reduce those. And the best way to do that is to increase lifetime value of customer and really understand your audience. And tell that lifetime value story clearly. And that's why I love when sellers work with a company like Azoic, because they do come to us with a ton of data about who their customers are, who their audience is. And it makes our lives very easy as we go to present that story to buyers. And then just understand that better lifetime value can improve both the valuation and deal terms and more money in your pocket today. It's almost a no-brainer, in my opinion, to focus on this as a business owner, because you're making more profit today, and then the business is more attractive in the future, meaning the trailing 12-month EBITDA is increased, and then the multiple a buyer is going to put on that EBITDA is increased as well. And so you do the math there. I mean, it can lead to very, very significantly increased deal terms for you at the end of the day by making simple, easy changes that Zoic can help you with.
Yeah, and I don't want to sound like too much of a broken record, but I cannot stress the value of first-party data enough. Advertisers want to buy there. Publishers aren't presenting that information for them. So those that are, they're capitalizing tenfold. It's definitely something you want to invest in. Capture viral traffic, get reoccurring audience coming back to the site, understand the value of exchange from the formats and offerings you have, and then think about it from an advertiser perspective. Is the media quality high? Is it, super heavy with impressions? Am I getting a return on my investment? So think about it from the advertiser perspective when you are going through those things, and also the user perspective. But that first party data, I cannot stress enough, is such a golden opportunity for all you guys, whether you're utilizing it or not.
Cool. Awesome. Well, I think that brings us to the Q&A time. I know we're at, basically the time here, but we carved out extra time, so we're not in a rush to jump off. If there is anybody who has questions, Alex, do you have a list of acronyms? Yeah, sorry about you, all the acronyms. Apologies for that. If there are any specific you want, to know what they are, just, reach out to me afterwards. You could scan this, you'll get my LinkedIn, just shoot me a message there. Happy to answer any of those that you have. Otherwise, yeah, feel free to jump in, submit a question in the chat, or there's a question tab as well. You can submit your question there. I answered a few of them throughout the call in the question tab. So if you didn't see that, if you submitted one of those, I think Chris had a question, Charles had a question. So answer some of those in the chat there. But I'll give 1 to 2 minutes here for people to submit some questions. If none come through, then we'll wrap it up.
Yeah, I threw my email in the chat as well. If you guys just want to reach out and say, hey, there was a lot of information shared, can you take a quick look and give me some insight on what you see, what you like and don't like? I'm more than happy to do that. It's very enjoyable for me to do, and I'm happy to help you guys out.
Yep. Yeah, and I think after the call, you'll get as mentioned up at the top of the hour, you'll get a email that has a copy of the recording, and then I think we'll also be sending you some like checklists and things you can use both on the Flippa and Zoic side that should be helpful for you as well, as you're either looking to build up a business that focuses on lifetime value, or if you're close to the exit, things that'll help you gather everything you need to be ready to go to market. Cool. All right. Well, it looks like Ashley's typing, so we'll okay, cool. She has a newsletter. It goes over a year period. Cool. 24 games. So yeah, Ashley's going to follow up with Charlie. That's great. Awesome. Well, it looks like there's no additional questions. So appreciate everybody's time. Yeah, feel free, again, scan these. Charlie put his email in. I'm going to put mine in. It's just jared.lauber@flippa.com. You can reach out to either one of us. All right. Thanks, everybody. Appreciate the time.
Thank you,
Thanks,
everyone.
Charlie.
Thank you.